Good evening and welcome to the Investor Signals Global Equities Overview for 2018. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presenter tonight, myself, Leon Hine, Managing Director of Investor Signals. I have 22 years of experience in the financial services industry and a current licensed securities and derivatives advisor. The chart up on screen here is the graph of the Dow Jones Industrial Average, and it shows the driver of global shares being the US equity markets that have really delivered the outsized returns. And to put specific numbers around that, the S&P 500 has returned roughly 350% since the 2009 low, which works out around 19% annualized. The concern for investors, I guess, looking out into 2018 is the PE valuations of equities are relatively stretched, and there's some question marks around what the earnings growth picture looks like in 2019. And our base case is that equities probably don't deliver the same level of return that they have done over the last 2 or 3 years, and we're probably in for a period of more sideways consolidation for global equities. When we look at the global outlook for the economy, we recognise that 2017 delivered GDP that exceeded consensus expectations. I guess if we go back 12 or 18 months ago, the expectation was for GDP to be around 3.3% 17, and it came in above that, and we're starting to see the benefits of this synchronized growth that's occurring. And when we look at the 2018 GDP forecast, we're likely to see that pick up slightly from 3.7 to 3.9, and again that's higher than where consensus expectations were sitting not too far back. Obviously a key driver of equities at present is whether the US tax reform occurs, and we're expecting to see an agreement on that by early 2018, so maybe as early as January. One point of note is that we expect Chinese growth to slow gradually from current rates of around 6.8% down to maybe high 5s or 6% in 2018 and 19. We recognise that there's above average growth occurring in India and Russia, and growth is still rebounding there. Other key points that you're probably well aware of is unemployment rates across advanced economies has fallen back to pre-crisis levels. And when we look at the S&P 500 from an earnings per share perspective, forward estimates sit at around $148 of earnings per share. And in 2009, that growth rate drops off a little, but forward expectations are for around $155 of earnings per share. So when we look at that in percentage terms, 2018 delivering about 11% underlying EPS growth, and that moderates to around 6% EPS growth in 2019. And for those numbers to be achieved, we're assuming that tax reform is passed. The interesting, I guess, part of looking at US equity earnings is when we go back roughly 2 or 3 years, S&P 500 earnings were delivering about $115 to $120 of earnings per share. So it gives you an idea of the growth rate that we've seen. In 2017, that's about $135 to $137 of earnings per share. So that starts to give you a bit of a picture of what that growth rates look like over the last 2 or 3 years, and what targets of growth are sitting there to achieve that sort of 148, 155 level. But our base message is that we think lower growth momentum will deliver lower investment returns as a broad basis, and that feeds into our view that global equity trade more sideways or consolidate than what they have done over the last, certainly over the last 12 months. Key points to consider is when we think about liquidity, that's helping to support the equity markets. We look at valuations, where do PE stand from a historical standpoint, and what kind of impact have share buybacks had on valuations. And just to reflect a little bit on this share buyback issue, so it's not uncommon in early stages of economic recovery in cycles that you'll get 2 to 3 years of share buyback while shares are at a discounted rate and companies have excess capital. It's not uncommon for them to buy back their shares, which enhances the average earnings per share. It is somewhat unusual that we're 9 years into an economic recovery, or 8 or 9 years into an economic recovery, and we're only now starting to see some sign of deceleration in that rate of share buybacks. So to put that in context, since the GFC, there's been over $3 trillion spent by S&P 500 companies in buying back their own shares. Now, that's a win for the directors of the companies, but it's also a win for shareholders. So there doesn't appear to be any limit to that trend continuing for the time being, albeit in logical sense, there is a point where you simply can't. I guess when you think about IBM, they've roughly cancelled 50% of their shares on issue over the last 20 years. Companies like American Express spending $8 or $9 billion buying back shares. You would suggest that there's a point that maybe that can't continue at the rate that it has done. So when we look at the numbers on that, in 2017, there was roughly $510 billion spent on share buybacks, and that was down from $590 billion that was spent in the prior 12 months. But by any measure, these are enormous numbers, and if we go back and reflect on the earnings per share, I said sort of 3 years ago it was tracking around 115, 120. We're now up to 137, $137 of earnings per share. It's forecast to go to 148. Share buybacks have actually played a fairly important component in that earnings per share growth that we've seen. So where we have the S&P 500 on valuation terms, on current earnings, we have it on 22 times earnings. If we look and assume that the S&P 500 delivers around 11% earnings growth over the next 12 months, that PE falls down to 19 times earnings, which is still high from an historical perspective. And when we get into the ASX market, we'll have a look at some specific PE valuations and the expansions that we've seen in some of the blue chip stocks on the ASX. The S&P 500 trades on a 2.3% yield, and year to date the market's up about 17% as we speak. Other interesting sort of point of consideration here is again the role that the central banks play and where they sit in the market at the moment. The Bank of Japan has been very aggressive in buying equities directly through exchange traded funds, and they're now a very large shareholder of most of the 225 companies that make up the Nikkei index. So the Bank of Japan, the ECB, and the PBOC, which is the Bank of China, continue to provide liquidity, albeit that the Bank of China are arguably starting to sort of tighten some of their lending conditions at the moment. Whether you can form an investment view around this data that I'm about to talk to here in regards to debt to GDP, or whether it's just important background knowledge for listeners of tonight's recording, I find it interesting just to sort of pause for a moment and sort of run through this data. In 1933, debt to GDP was nearly 300%, which was 100 points higher than any past crash. And that was one of the reasons why the Great Depression was, such a severe market reaction. It took 70 years for the United States economy to reach a level of indebtedness that surpassed 1930. So in 2008, the US economy had reached a debt level of 350% of GDP. And if we have a look at this graph on screen, what it's telling us is a combination of public and private debt in the US as a percentage of GDP. And for the most part, from the Great Depression, that ratio was falling down to sort of roughly where it touched about 100 and just over 100 percent of GDP, and then around 1980 that started to increase, and obviously over the last say 17, 18 years, we've seen a fast acceleration in that ratio of debt to GDP. Whilst we'd like to think post-GFC that issue was fixed, the reality is it now stands at a higher rate than what it did pre-GFC. So total economic debt for the United States has now surpassed $70 trillion, and it stands at roughly 370% of GDP. So not only has the issue not been resolved, it's actually worsened over that period. And if we have a look at sort of other major economic regions of the world and have a look at that in a comparative term, China stands at nearly 400%, Europe around 475%, and Japan at almost 600%. So whilst the share markets continued to perform well, despite this backdrop of rising debt to GDP, I suppose it's just something that the bears in the market will point to this as a reason for concern. So I think it's worth just sort of reviewing it and starting to appreciate the impact that increase in debt has on global markets. And this probably chart shows up where the impact is the strongest, which is that we're looking at a graph now, the 10-year Treasury rate on US bonds, and what it shows that was essentially since 1980, when that debt to GDP ratio started building, we've had a situation where each period of economic expansion and where interest rates have increased, it's failed to create a higher rate of interest rates. So you've got this falling yield on bonds, and it's a pretty clear trend there that we see, and it's almost a race to the bottom. And in many parts of the world, interest rates are at or near zero, or in some cases negative. So when we look at the 10-year rate in the US trading somewhere around 1.6 approximately at its lows, up to around sort of 2.4 where it is presently, it's still at the very low sort of levels of the range that it's traded at. So the question mark really becomes, what sort of pickup in global economic growth do we need to start to see a reverse of this sort of downward trend in interest rates? And the implication for this is that obviously the flip side is that in a low interest rate environment, PE valuations trade at higher levels, and investors are pushed out of low risk yielding assets into higher risk investment, and we've seen that in the benefit or the strong share prices of, say, infrastructure stocks as an example, or yield sensitive stocks that benefit from low interest rates. So as we roll through and have a look at some of the ASX stocks at the back half of tonight's recording, we'll have a look at sort of the benefit that this low interest rate environment's provided to some of the ASX 50 stocks that are yield sensitive names. When we look at the Bank of Japan and the impact that they're having, I think it's just worth recognising this graph on screen, I think, illustrates, if we go back to 2012, the Bank of Japan had a very small holding in direct equities, or in particular through their exchange-traded fund market. And then by 2016, that had increased to where the BOJ was responsible for owning roughly 50% of their exchange-traded fund market. And over the course of the last 12 months, we've seen that ratio increase to them being holders of roughly 2/3 of the exchange-traded funds, or the broader 225 index. So if we look at sort of the impact that's had on Nikkei 225 index, if we sort of think back here to 1989, when the index, where the bubble burst, and effectively had a 30-year contraction in the price of the Nikkei index, and it's only really been in the last, say, 4 years that the index has found a support and gradually started to trade higher. And within this period, we've seen the Bank of Japan becoming a substantial buyer of Japanese equities, which has ultimately helped to drive up the value of those assets. But you can't deny that there's been a turnaround in the Japanese economy. We're starting to see better growth numbers, some level of inflation. But the question mark, sort of, if we jump back to this chart here, at what point do these central bank strategies sort of run their course and plateau? And I suspect we're relatively close to those levels now, which again sort of feeds into this idea that we're far less likely to see the type of growth that we've seen, or support even, in asset prices over the last say 5 to 8 years, to what we're probably likely to see over the next even 2 to 3 years. Up on screen here is just looking at a bit of a cross-section of emerging markets. So starting in the top left-hand corner, this is the iShares ETF of the emerging markets. So it just shows you over the last couple of years the strong performance of emerging markets, and part of the driver there has been, again, this synchronized global growth, slightly lower US dollar than maybe originally expected 12 months ago, has helped add to the uptrend here in emerging markets. If we move over to the top right corner here, we look at the iShares Asia 50 ETF, which is effectively the top 50 stocks in Asia. Again, over the last 2 years, it's been a very strong performer. Europe, so we've seen a rebound in Europe over the last, say, 12 to 18 months. And in China, if we think back to 2015, the index there had a significant sell-off, and since 2016, we've seen, for the most part, a pretty steady upward recovery in Chinese large cap stocks. So I think that just sort of sets a little bit of a background there across different sections of the global economy, and how those trends have been playing out. The Australian equity market, far less exciting. So if we look back over, say, 2015, 16 and 17, our market's mostly at the same level it was 2 or 3 years ago. When we look at our PE ratio, it's far more modest at around 16, 17 times earnings. We trade on a higher dividend yield. So when you look at the S&P 500, around 2.3%, we're at 4.4%. And year to date, our market's only up around 5-6%, and most of it has 8 weeks or so. The reason why, or one of the reasons why, the Australian equity market has underperformed is when we just look at the graphs up on screen there. The Australian banking sector is roughly down sort of 20% from its highs of 2 years ago. The mining sector's done well, but at an index level, the two have sort of offset one another, which has helped to create a bit of a drag on the performance of the XJO. So again, as we go through the individual stocks in the top 50 in the back half of tonight's presentation, we'll take a closer look at the trends that are strong and likely to continue, and the contrast of the trends that are negative and probably likely to continue that way. When we think about the Australian market, there's obviously a lot in the press about the Aussie households and the debt level. And that's likely to act as a concern for the RBA, as we know, and interest rates are probably unlikely to rise at the same rate that they may do in the US. And that's just something that we'll probably continue to think about in the context of the Australian market, and the wall of money that's going to continue to come out of superannuation and support Australian equities. So when we look at the ASX outlook, we'll probably continue to deliver some level of underperformance against global peers, and I think that just reflects the fact that the Australian economy hasn't really decisively broken out of its post-mining slump, albeit the building and construction industry has provided a great support. We think that investors continue to search for yield, as I just spoke about, and although equities have benefited from a compression in dividend yields or an expansion in PE ratios, there's a limit as to how far that strategy can run. And again, when we go through some of these stocks, we'll have a look at them from a valuation standpoint and just understand probably where those valuations were at 4 or 5 years ago relative to where they are at the moment. So just recognizing that there is a limit to the PE expansion. So then when we look at underlying earnings for the top 200 companies, it's probably likely that we'll only average somewhere around 5 to 7% of earnings growth over the next 2 years, which is well below the earnings growth in the US. And again, that will feed into our market continuing, to lag global peers. Our solution to this lower growth environment on the Australian market is we think investors should be using covered call options to enhance the returns, especially on low growth blue chip stocks. So again, part of tonight's strategy is we'll look at which stocks are likely to deliver fast or higher growth, which stocks will be low growth, and identify the ones that in covered calls to. Using the covered call strategy, we think it adds around 6 to 8% of additional annual return. So this particular chart here, this is where we start to get into looking at the valuations and forward growth forecasts for the Australian market. And this is really just to point out in the office here the type of data that we focus on in determining the valuation of top 50 stocks. So just to walk you through this table, if we look from the sort of top here, so AGL trades on a PE of around 16.5 times earnings, and that assumes about 13% of earnings growth over the next 12 months to get that 16 times earnings, or 16 PE. So that puts the stock on a yield of about 4.5%. If we go out into 2019 and we assume that same growth rate continues, the PE falls down to 14.5 times and the yield jumps up to around 5%. So these earnings growth rate are obviously central component in determining fair valuation for equities, and we feel sort of a combination of combining fundamental analysis with technical, which again we'll look at in the back half of tonight's presentation when we look at some of the charts, and as we roll through these stocks we'll identify the names that we think the trends continue over the next 12 to 24 months. So just moving through that list and just looking at a couple of other examples. So Aristocrat Leisure, growing earnings at around 16-18% per annum, trades on a fairly high multiple, so as that earnings growth rate trades at that higher bound, then you'd expect the PE to be slightly higher as well. So being a growth company, the dividend yield's lower, in the case of Aristocrat only yielding around 1.9%. So if they continue to deliver around that 16 to 18% earnings, the PE drops down to 20 times in 2019. And that's financial year 19, puts the stock on a 2.28% dividend yield. So when we look at that from a dividends per share perspective, in 2018, they should pay out 45 cents. In 2019, we see that push up to 54 cents. And we look at the earnings per share picture, so $1 in 2018, assuming about 16% earnings growth, that increases to $1.16 in financial year 19. So comparing, say, a growth company like Aristocrat and looking at something that's a little more defensive. So if we jump down here to, say, ASX, and we have a look at that, trades at 23 times earnings, which is fairly high for a company that's actually not delivering a particularly high growth number. So if we come across to here, it's growing earnings at about 4 to 5%. And that's fairly sort of optimistic, or at the top end of the range. We may even see that number come in more around 2 or 3%. But in both the half year and full year results in the office here, we continue to track the relative performance of those earnings numbers to these consensus expectations to help support the valuations that and the price targets that we're forming on these companies. So something like the ASX, to give you an idea, when interest rates were at higher levels, if we go back 4 or 5 years ago, historically on a PE ratio normally of around about between 14 and 16 times earnings. So a lot of the share price appreciation is not necessarily because of an uptick in earnings growth. It's that expansion in PE. So earlier in the presentation, I spoke about that there's some limitation to this PE expansion part of equities moving higher, and it would seem that we're pretty close to the top end of how far that can stretch. So in the case of something like ASX, the logic here is that the earnings appear fairly defensive, and therefore the market's continually willing to sort of consider this as an alternative to low interest rates, where you can get exposure to a high quality blue chip stock, 3.9% dividend yield, 100% franking credit. So from our point of view, for that to be a viable strategy, we think that you need to overlay a fairly tight covered call on these type of investments to boost that cash flow from 3 or 4% up to 10 to 12% per annum, which is then giving you a little bit of downside protection in the market as well, but still keeping you exposed to the dividends and the franking credits. So we're very select on which stocks we add to the model portfolio, and then within that we then analyze which ones we complement with a covered call. So something like Aristocrat Leisure, which is a higher growth name, for example, you may be more inclined to not use a covered call there, and maybe apply a stop loss on a break below a major change in trend in Aristocrat. Just to look at maybe one more example before we move on. If we come down to, say, a property trust, so GPT, it trades at around 16 times earnings, 5% dividend yield, and delivering about 4 to 5% earnings growth. So quite often with the derivative strategy, what we'll try to do is set the derivative overlay in between the dividend cycle. So most companies pay a dividend twice a year. So if in between those payments we can set the call option, effectively what we're doing is getting 4 payments throughout the year, 2 in the form of dividends, 2 in the form of call option premium, and again a combination of that, we start lifting that cash flow up to 10 to 12% per annum, while still allowing for some capital growth within the portfolio as well. So when it comes to the stocks that make up our model portfolio, we have an algorithm-based system that helps alert us to stocks that are making troughs within an uptrend or a peak within a downtrend. The algorithm that we run, which we'll look at a couple of examples, helps to create this model portfolio. So when we have a look at the screenshot at the moment, the best performing stock within the model portfolio is Aristocrat Leisure, and we've held that in the model since April 2014. The stock's continued to make higher highs and higher lows. It's up 375% since it was added, which shows here the days that it's held, the accumulated dividends and the franking component. Looking at the next one, Treasury Wine, so it's up 219%, CSL. So this is the ASX 50 model portfolio. So CSL up 55, NAB up 31, Origin 24. So within the software or that we provide our members, we have sort of the news, which links to our blog, the charts, the watch list, model portfolio, and Thursday night's webinar will be where I sort of focus on introducing you to this technology and explaining more about how it works. But I just want to put in a screenshot there of the model portfolio. Looking at the performance of the model portfolio, so if we just have a look at the summary on screen here, this shows the performance of the algorithm system or the model portfolio going back to April 2010. And it's delivered an annualized return of around 14.14%, which has significantly outperformed the ASX 50 index. So we've done a lot of testing on this, and the recognition is that the algorithm on individual stocks outperforms the index, and importantly, it has a ratio as to how much you're invested in cash and how much you're invested in stocks at any point in time. And if the bulk of the market was to roll over and start making lower lows and lower highs, there's an automatic transition from equities back into a higher holding or higher level of cash. But the analyzed performance on this is very encouraging, the research that we're seeing coming through on this model. All right, on that note, I'll jump into the charts and we'll have a quick look at the we'll have a quick look at the charts of some of these top 50 stocks and identify which trends are likely to continue into 2018 and which ones are likely to maybe continue or continue to underperform. So for the first thing we do is we come in here, we select the watch list, we go to ASX top 50, and we jump back into the charts and we just start moving through these fairly quickly. I'll go back to the start of the list. So AGL. So at the top of the screen here are the sell signals. So they're the algorithm signals that make up the basis of the stock being added or removed to the model portfolio. The green signals here are the buy signals. So in simple signals, they're the stocks in the portfolio. When the red signal occurs, it gets removed. Next green signal, it's added back into the model, and so on. So if we just start rolling through these, and I'll just share with you on occasion, not on every stock, but some of these valuation references from that table that we looked at earlier in the presentation. So AGL is a stock that we like and that sits in the model, and we see this stock as not necessarily a fast growth stock, so therefore we are complementing it with a covered call. So we're selling call options just over, so around this 26 to 26.50 level. AGL pays a dividend in late February, March, so we're selling those call options on the other side of that, so getting exposure to that March dividend plus the extra premium from the call option. If we look at Aristocrat, so this is one of those companies that we like. It's been in the model portfolio for a number of years. And if we sort of look back at the history here, in 2010, 2011, the stock was in a downtrend and therefore it was not in the model. And then in early 2014, the uptrend started to develop and the algorithm added it into the model portfolio. And as I mentioned earlier, it's one of the best performing stocks. Where we sit at the moment, we had the most recent algorithm buy signal here at around $19, $20. And we think the stock continues to move higher based on that momentum and the underlying earnings growth being sort of one of the better performing growth stocks within the ASX 50. So in contrast, something like Amcor, so whilst it's in the model portfolio, so we have the recent buy signal there at 15.15, we've sold fairly tight covered calls over this name because we see it as a defensive earnings contributor to the portfolio, but it certainly has a lot lower level of earnings growth. So something more around that 5 to 7% of underlying earnings growth. It's on about 18 times earnings and a 4% dividend yield. So complementing that with a covered call makes sense to us. AMP's in the model. So as I said, a couple of these I'll skip through a little bit quicker. If you want a full analysis of these top 50 stocks, you can access the monthly strategy recording, which is a full sort of half an hour coverage on the top 50 stocks. I'll just summarize this tonight and then guide you towards that if you want more information following the presentation this evening. ANZ's currently in the model as well, albeit recognising that these Aussie banks are under pressure following the announcement of the Royal Commission. But it's interesting when you consider the banks that the algorithm has in its model and the ones that it doesn't. So for example, CBA's, when we get to that, you'll see a negative price structure and that's not in the model, but ANZ is. APA Group, so that's not in the portfolio, so we're still just cautious on that at the moment. So if we look at this from a technical perspective, it was in the model back here at about $8.30, and then recently, as it's pushed up into this sort of mid $9 range, it's been removed from the model. And until such time as the stock really breaks out of this sideways consolidation, we probably won't see it added back in again. ASX, so this is a stock that we looked at. We reviewed the PE ratio. The algorithm engine added it into the model at $48. We're now trading $57. So something like AZJ, it's not in the model, so quite a different technical structure here. We can see this stock's mainly moved sideways over the last, say, 3 years, and it's got the early signs of a lower sort of high structure here, and the algorithm engine has removed it from the model. So if we go back and trace the history of that, it was added into the model at around $4.30, and then it was removed at around $5.25. BHP, so this is in the model portfolio. It was added in sort of throughout this stage here at around this $23 level, and we continue to see BHP moving higher, and resources likely to be sort of one of the better performing asset classes, and maybe the banks continue to underperform or trade sideways at best. Brambles, so we can see here that it had been in an uptrend, and during various stages of that uptrend it was added into the model, then later removed, added in, and then over the last 12 months the stock's rolled over. We've seen earnings downgrades, and as a consequence the stock's made lower lows and lower highs, and the algorithm engines ensured that it's not been sitting in the model portfolio over that 12-month period. In the case of CBA, we've seen the uptrend come to an end. It's rolled over, had negative price structure through here, and if we look at it, the algorithm engine again's ensured that it's been removed from the portfolio. The one buy signal that we did have on it around this level here was later removed under this sell signal. So currently, when you look at the 4 major banks, CBA is not one that's in the model portfolio, and that shouldn't be a surprise given this bearish price structure that we see in CBA. Computershare, we don't hold that in the model. CSL, so this is one of the better performing stocks in the model. You can see here the higher highs, higher lows. The algorithm signals triggered these buys. The most recent one down here at around 120 in the stock trading 144. And if we just jump back to that model portfolio, switch it over to ASX 50, organise them in alphabetical order, go down to CSL. So we can see there that it was added into the portfolio in May 2015 at $90 and currently up 60%. So what it's looking at there is the last time it switched from a sell signal to a buy was back there in May 2015. So given that the stock's already in the portfolio at that point in time, it doesn't subsequently continue to buy it on these signals, but certainly the next sell signal, it'll be removed from the model. Caltech, so currently not in the portfolio. Dexus is, so we can see there the algorithm buy signal. Fortescue is in the model. Goodman Group, so one of better performing property trusts, so we can see here that's picked up the higher highs and higher lows. So the message from tonight's recording is that these stocks that are in the model that have bullish technical structures, we have every reason to assume that the momentum in those names will continue. And it's not until they actually roll over and make a lower high that you'd have a reason to remove those stocks from your portfolio. So GPT was one of the property trusts we looked at. We spoke about that it traded about 17 times earnings, roughly a 5% dividend yield, delivering about 4 or 5% growth, which is probably at a reasonably higher end to, say, Westfield and Scentre Group, which are maybe more around 2 to 3% earnings growth. So GPT, we own it. It's in the model. We think the stock's getting a little bit expensive now, so we look to sell the covered calls on the other side of the next dividend. Insurance Australia Group has been a terrific performer in the model portfolio, so the algorithm buy signal, so it went from a sell condition in late 2016 to a buy condition here in early 17, and the stocks continue to make higher highs and higher lows, and for that reason it stays in the model. Incitec Pivot, again, buy signals down here. It's in the model, one of the better performing stocks. James Hardie, so we're concerned with this name here. We think the technical structure here where the algorithm engine's flagging the sell signals, that we're starting to see a lower high formation, and we think James Hardie either trades sideways or possibly rolls over and moves lower, but at the moment we don't hold it in the top 50 model. Lendlease, higher highs, higher lows, the algorithm signal here, and it's in the model. Mirvac Group, so it's been a strong contributor to the performance of the model portfolio, and we can see there the buy signals on the higher lows. Medibank, so again, strong performer in the portfolio. So to give you an idea on Medibank from a valuation standpoint, the stock trades about 20 times earnings and about a 3.85% dividend yield. The earnings growth is probably only around 4%. So this is another example of where we really like this name, but we see it as full value. We recognise that in a low interest rate environment, there's a lot of money searching for yield. Medibank earnings would appear to be reasonably defensive, but to own the stock at these levels and be settling for a 3% dividend yield doesn't make much of a risk reward sense to us. But when you overlay, say, a $3.30 covered call and you're getting an extra 10-12 cents of income for that, plus still getting exposure to the upcoming March dividend of 5 or 6 cents, that's how you start to get that 10 to 12% annualized cash flow from these names and still keeping access to the franking credits. Macquarie Group's been removed from the model, so it'll be interesting to see how it's certainly been weak over the last few days, and that's not in the model portfolio at present. It is the top 4 banks that's currently in the model. Newcrest at the moment, mainly tracking sideways. Origin Energy, so again, I think this is a great illustration of how the algorithm engine works, that if we go back to say 2011, 2012, Origin was a solid performing stock. Certainly in 2013 and 14, the uptrend was strong. And then around 2015, the stock started to break down. When that happened, the algorithm signal removed it from the model. So it was in the portfolio throughout this stage, and then it was removed just here. Later, Origin fell from $13 all the way down to around $4. And then over the course of the last 2 years, we've seen a gradual recovery, and Origin was added back into the model portfolio here at around $6. And this is one of the stocks that we've been a strong advocate of in our client portfolios. We start to see that it's getting close to full value where it is at the moment, and expect it to either trade sideways or maybe come off a little. But from a pure technical standpoint, it still sits in the model portfolio as the stock's making these higher highs and higher lows. Orica, it's still in the model portfolio at present. Oil Search is not. Qantas is. So you can see here we had Qantas added at around this $5 level, and the stock's a few percent higher than where it was added. So again, in contrast, so looking at QBE, this is a company that's continually failed to meet their earnings guidance. They have a history of insurance margins coming in below consensus expectations, and if we look at the technical structure of the stock, it's mostly been making lower lows and lower highs, and that's been reaffirmed on the most recent signal here, where we had a sell signal at around $11. So you have to go back some time to find a buy signal here in QBE, and it was only maybe a month later or a few months later that it was removed from the portfolio. So it's not until such time as this sort of downward structure here ends and we start to see a more bullish price pattern develop that it'll be added into the portfolio. So there's an example of a stock that, whilst it might be tempting to look at it, the algorithms will alert us to the time over the next 12 or 24 months when the stock starts to build a more bullish structure. Ramsay Healthcare, so this we can see if we go back 2011, 2012, when the stock was in a strong uptrend, the algorithm signal had it in the model portfolio, and then over the last sort of 2 years, the stock's consolidated, moved sideways a bit more, and it's sort of moved more into a trading range where at times we've had it in the portfolio, then it's been removed. And most recent signal here is just suggesting that's probably likely to run into resistance again around this sort of $70 level. Rio, so that's one of the strong performers there. We can see the algorithm signal adding it to the model there. South 32, so again, these resource stocks are really a winner as goes in the market at present, and we're happy to take a view that that continues until such time as there's evidence that it doesn't. But whilst the market's making these higher highs and higher lows, they're the stocks that you need to be focused on. So Scentre Group fits that. So to put some numbers on Scentre Group, trades at about 16 times earnings and about a 5.3% dividend yield. So again, we complement that. Instead of delivering a 5% yield, we sell covered calls up at around 430, 440, get the next round of dividend and turn that into a 10 to 12% cash flow story over the next 12 months. Stocklands, Sonic Healthcare, so this is one that's in the model. I'll just skip through these last few. I'm mindful that we're running close to sort of schedule here. The webinar's been going about 45 minutes. Santos, so we're not holding that in the model. Suncorp, we're not. Sydney, we are. Transurban, we are. So these are a couple of examples of stocks that are doing very well in a low interest rate environment. So they're infrastructure names that are yield sensitive. Telstra, so it's been in a downtrend. This is an interesting one just to pause and take a look at. So we had been in an uptrend, rolled over into a downtrend, mostly sell signals throughout Telstra. The most recent one was a sell signal at 525. We don't yet have a bullish or higher low structure, but certainly given today's price action, may be the beginning of the market starting to look a bit more favorably on Telstra's long-term perspectives, given the issues that the government's having with the rollout of NBN. So over the course of 2018, if we start to see this move higher in a higher low formation, we'd expect to see that added back into the model. Treasury Wine, so a little like Aristocrat, this is one of the faster growing stocks on the ASX, delivering around 20% earnings growth per annum. And we can see there that it's been in the model portfolio since 2014. Westpac's in the model, as is Wesfarmers. Westfield's not. Woolworths was just removed from the model at $27. Woodside has been added, so we recognise that this is making higher high, higher low. Energy prices have recovered substantially from their lows. Natural gas prices are very strong. We expect Woodside to move moderately higher from where it is, and there we are back at the index. So thank you for listening in to tonight's Global Market Outlook webinar. On Thursday night, we go into a bit more detailed review of the charts and algo engine. And if you're not already set up as a client to the charting service, then I'll just show you. So if you visit Investor Signal's website, so this is just what I recommend you do ahead of Thursday night if you're not already, if you don't already have access to our charts and algo engine. So go to www.investorsignals.com, click on Start Your Free Trial, fill in your email address, your name, your mobile, and then hit register, and you'll get a 30-day free trial to the charts and algo and model portfolio. So off the back of Thursday night's webinar, you'll be able to navigate your way around the platform and have a closer look at the stocks that are in the model, which are effectively the names that we're saying you should be holding moving into 2018. And on Thursday night, we'll look at the names that are not in the model to highlight that they're the ones you don't want in your portfolio. Thank you for listening in. I look forward to speaking with you and having you on board Thursday night's webinar.